Welcome to the sixth virtual event in the Global Adaptation Resilience Investment Working Group Speaker Series. I'm Lori Collins, Strategic Advisor for GARI. GARI is a private sector, private-led initiative with a mission to catalyze investment in resilience, particularly through the private sector. GARI was announced at the Paris COP21 and is a partner with the UN Secretary General's Climate Resilience Initiative. Our goal is to bring together public and private sector actors, as we have here today. GARI's is focused on education, expanding our reach, and driving innovation in financial instruments for climate resilience. And today's event advances all of those objectives. We appreciate the contributions of all of our panelists to bring this together. Today, we are joining forces with Arise US to bring you this webinar event. To introduce Arise US is board member of Arise and CEO of Climate Resilience Consulting, Joyce Coffey. Joyce is a leader in promoting equitable investment and policy in adaptation and has initiated and helped organize the major driver for this event today. So I'm pleased to introduce you to Joyce Coffey and turn it over to you.
Great. Thank you so much, Lori. It is an extraordinary pleasure to have the opportunity to have a GARI Arise US convening. This has been in my mind for many years, and I'm so thrilled to welcome my friends, Lisa, Lauren, Jessica, to give us some of their insights. Climate Resilience Consulting is a small business based in Chicago whose mission is to save lives and improve livelihoods through climate change resilience. And we do this work in partnership with many people, including many private sector actors. I'm pleased to be the co-chair of the board of Arise US, which is a member-led, all-volunteer organization that is focused on improving disaster resilience outcomes in the United States through the actions of the private sector. And we have a very formidable equity work group, and this convening came out of that equity work group. So we're pleased to be part of it. Thank you so much. Back to you.
So Joyce, I understand that we're joined today by Yazid from UNDRR. Would you like to tee up Yazid for us, please?
Yes, thank you so much. Yazid, it is a pleasure to have you here. We're thrilled that the UN is also keen to better understand how we can make sure that we create resilience for all through finance. And I'm really thrilled that you've taken such extraordinary leadership of the North America, Caribbean, Latin American Arise groups. So please share a little bit more about your work with us.
Thank you, Joyce, and thank you, colleagues, for joining us in this event. And on behalf of the UNDRR Regional Office for the Americas and the Caribbean, I'm honored to be at this event, and I'm glad to highlight the work of the Arise US network and the way that they work together with other organizations, and their exceptional work serves as an inspiration for enhancing our community strength and resilience in challenging times. As we know, climate change and other hazards are creating systemic risk that can majorly impact society. We also know that disasters disproportionately affect women and other vulnerable populations. Enhancing our comprehension of equitable financing in this current scenario is crucial. We must consider the requirements and obstacles faced by vulnerable communities. Finally, I would like to emphasize the importance of collaboration between businesses, communities, and governments in building a more resilient future. By working together, we can build a future where everyone can prosper regardless of gender or condition. In our region, we have 20 national networks of Arise across the whole continent, in North America, in Central America, South America, and the Caribbean. And we have two sub-regional networks, one in the Caribbean with CARICHAM as a leader, and one in Central America integrarse. And we have the idea to work together around among the networks. And I know Arise US and this work with GARI could be a good idea, a good inspirational thing to work with other organizations and other networks in the region. Over to you. Thank you.
Okay, great. Thank you, Joyce and Yazid. Really appreciate you being here and your sponsorship of this event. Now I want to introduce Andrew Isle, who is our moderator for today. Andrew is a climate risk and resilience investment consultant. He is currently head of climate risk for North America for Tata Consultancy Services, which is a global IT solutions and advisory firm. He is a climate policy and market specialist with experience spanning diplomacy, development finance, and consulting. He supports engagements with financial institutions to address climate risk-related challenges and opportunities, and has worked on issues related to resilience since 2016. So Andrew has been involved with GARI since 2018. We've known each other quite a while, as we've known Joyce as well. Andrew joined forces with us at GARI in last year in 2022 to help launch this virtual speaker series. So this is the 6th speaker series event that he has worked with GARI to arrange. We really appreciate his leadership and his skills as a moderator, as you will soon see. So Andrew, I will hand it over to you. Thank you.
Well, thank you so much, Lori. We are old friends, and we've been at this for a while, but I'm super excited that this is our first collaborative GARI Working Group Speaker Series event. So hopefully the first of many, and I can't imagine anyone better to convene us than Joyce for that purpose. So very excited. A few words about today's event. Today on this panel, we will be focusing on incentives and structures that can best help attract private sector capital for equitable disaster resilience and recovery. The discussion amongst our panelists will highlight specific cases and initiatives that create equity in disaster resilience finance. It will feature leaders from various different regions of the world, including emerging markets, as well as the US and Europe, and it will explore a wide range of different types of disaster-related financing, including insurance, development finance institutions, private asset management, and providers of blended impact capital of all kinds. So to give us a little more of a grounding in this topic of equity in disaster resilience and resilience financing, I'd like to turn the floor back to Joyce to provide a bit of an overview for why addressing inequity in disaster-related financing is such a critical and urgent issue. And as we've heard, Joyce has been involved with GARI, as well as leading this Arise US effort. And so, and Joyce's professional practice, her work is really squarely focused on putting social equity first and promoting social enterprise resilient solutions. And so, Joyce, please help give us some grounding to this topic.
Great, yeah. Well, thank you so much, Andrew. And I really appreciate your partnership in thinking this through too, because I think although many of us know some of what we'll be hearing about today, it requires a bit of a frame shift and intentionality to put equity first. And many of us who've been in the field of whatever business for decades might need to change some of our work in order to make equity an actual outcome of climate change resilience. I mean, it is now well established that disasters have a disproportionate impact on socially and historically marginalized populations. In the United States, this includes Black, Indigenous, and people of color, rural people, low-income communities, and also the young. In the United States and in other countries, marginalized communities are more likely to live in areas that are vulnerable to climate change impacts, such as poorly connected rural areas, the wildland-urban interface, WUI, coastal regions, and other areas prone to flooding and extreme weather events. Additionally, marginalized communities often have many fewer resources and less access to financial assistance and insurance to recover from disaster impacts, which is one of the reasons why I think this panel is so fundamental to building equity-first climate resilience. So these systemic disparities often result in exacerbated social and economic vulnerabilities, especially among older adults, people with disabilities, children, women, and unhoused people. And this is true around the world. What we know in the United States, in fact, is that disaster recovery and the subsequent recovery dollars actually exacerbate inequity. So here in the United States, historically, our taxpayer dollars around disaster resilience have contributed to more inequity, white people getting more, Black people getting less. Poverty is both a driver and a consequence of disasters, and the processes that further disaster risk-related poverty are permeated with inequality. This last comment I made actually is a quote from the United Nations, not from me, and I'll put that in the chat. So I'm really pleased that we have such a rich panel to help us understand this today and also to really compel us to act. Andrew, back to you.
Thanks so much, Joyce. And it is very sobering to grapple with the reality that existing disaster resilience programs and funding are actually making these inequity issues worse. So I think we have got a lot of work to do to better understand the problem and to promote the solutions. But we have a fantastic panel to guide us through many of those best practices and breakthroughs. So without any further ado, let me introduce our panel. We have 3 fantastic women panelists today, an all-women panel, which is very exciting. We're joined by Jessica Jacob, CEO of Sherco & Partners based in Panama, Lisa Davis, Executive Director and Portfolio Manager for PGIM Real Estate based in New York City, and Lauren Burnhill, Managing Director of One Planet Ventures based in Portugal. We also will share recorded remarks from a 4th expert, Mitch Rayosa, the Chairman of the Philippine Insurers and Reinsurers Association, who unfortunately could not join us live. So a very brief housekeeping note before we dive into our panel. We will start with our video recording and then do introductory remarks from each of our panelists. Then we will turn to Q&A and discussion. And we also encourage our audience to drop questions into the chat window, which time permitting, we will draw from and answer towards the end of our session in a little over an hour. And just wanted to note that this event is being recorded, and we will make the recording available after the session. So to preface Mitch Rayosa's remarks, let me give a brief introduction for him, and then we cue up the video. Mr. Michael F. Rayosa, or Mitch as his friends call him, is the Executive Director of the Philippine Insurers and Reinsurers Association, PIRA, serving initially as chairman in 2010 until his appointment to his present position in 2018. In addition to his post at PIRA, Mitch sits as the newly elected president of the AIC, the East Asia Insurance Congress, and he's a trustee of the Insurance Institute for Asia and the Pacific, and serves as the chairman of the Education Committee of the ASEAN Insurance Council. And he's also the committee chair of one of the 4 priority areas of the ARISE Philippine Group, Private Sector Alliance on Disaster Resilient Societies. So now over to Mitch for his recorded remarks. Joyce, I don't think we're getting the audio. Could you restart the video, please? I think you're on mute.
Joyce, you need to unmute your feed as well for the video.
Is that the further US dollars 368 billion will focus on the issue of an equitable disaster recovery. In a recent study released by Swiss Re about a week ago, it appears that the gap between natural catastrophe exposure and how much of it is protected by insurance programs has increased to US dollars 368 billion. Another way of putting it is that the further US dollars 368 billion in future insurance premiums would be required to cover this gap. This came about as a growth in exposure to NatCat events is far outpacing resilience increases around the world. The Swiss Re study opines that up to 76% of NatCat exposures are left unprotected by insurance. If we factor in the sad fact that only a small minority of those exposed, such as conglomerates, huge corporates, high net worth individuals, or those who can afford to pay premiums to obtain insurance protection, leaves the remainder of the populace. Unfortunately, the ones who are most vulnerable, unable to have themselves covered. This is the crux of what we would want to address in this series of talks. As if that were not enough, another unfortunate truth is that this sector, already woefully underserved by traditional insurance, are also the ones who live and work in the most vulnerable areas to NatCat events. Digging a deeper hole, it is becoming more apparent that disaster recovery itself exacerbates this gap. It is also true that poverty is both a driver and a consequence of disasters, and that the processes that surround it are permeated by inequality. These, in essence, are what we have to address and find a solution for. Our speakers today will focus on incentives and structures that can help attract private sector capital, which to my mind is the linchpin to the overall solution.
Thank you, Joyce, and thank you so much to Mitch in absentia for those remarks. And indeed, there is a set of interlocking challenges, both related to the underlying climate exposure, as well as increased vulnerability, lack of resilience, lack of access to financing, lack of access to insurance. There are a lot of challenges here that are reinforcing this inequality. So let's turn to our panel to unpack some of this and look at the solutions. We'll start with Jessica Jacob. Jessica is the CEO of Sherco & Partners, a consultancy specializing in environmental, social, and governance issues, climate finance, and sustainable digital solutions. Previously, she worked at the Green Climate Fund for more than 6 years as regional manager for Latin America and the Caribbean, and as accredited entity specialist, supporting nationally designated authorities, direct access entities, and general relationships with stakeholders from the LAC region. Before that, Jessica was the environmental and social director of Finditer, National Development Bank in Colombia. She's been president of the Colombian Green Protocol, chair of the Latin American Task Force for the UNEP Financial Initiative, and vice president of the Environmental and Climate Change Committee of Financial Institutions Elite. While at UNEP Financial Initiative, she headed the Latin America, Iberia Peninsula, and Africa Task Force, and in 2012 created and promoted Green Protocol in Colombia and coordinated the regional study Sustainability Integration of Latin American Financial Institutions. She's also worked for the Swiss Agency of Development and Cooperation, HSBC Asset Management, and Deal Tradition as a broker of inflation-linked bonds. So Jessica, thank you so much for joining today's panel, and tell us about how your experience has highlighted some of these issues of inequity and how your work, particularly in Latin America and the Caribbean, has helped to tackle them.
Thank you very much, Andrew and Joyce, and all the panelist members and those that are listening to this amazing event. So as you mentioned, Andrew, kind of the summary of my background is finance. And each time with life, I realized that we cannot have finance if we don't orient it for a sustainable matter. And in my case, my passion is climate change. So I'm today well known as a climate finance expert in this region in Latin America and the Caribbean. And I worked, as you mentioned, in different financial institutions, investment banks, private banks, public development banks, among others. And this trajectory helped me to reach to the biggest today climate worldwide fund, that is the Green Climate Fund, where, as you mentioned, I work for more than 6 years and mainly focusing on this region of Latin America and the Caribbean. So for all in this room, just in case, you know, it's the GCF was a great experience, no, working in this biggest climate fund, but it was a great challenge. You know, it was a new institution that was funded not more than 15 years ago in COP in Cancun, and we had to build all this structure and manage the expectations from the public and from the private sector. So one of the first expectations is how to help to reach these resources through what they call the accredited entities that have to go through a very difficult process of accreditation, evaluating all the fiduciary standards, environmental social safeguards, gender policies, etc. So my first role at the GCF was how to help what they call the direct access entities, that are the nationals and the regionals, to access. So it was a very challenging, but I was very proud to help these entities like environmental funds in Colombia, in Peru, in Brazil, in Mexico, development banks, regional development banks like CAF, Caribbean Development Bank, among others, to get this accreditation and then be able to propose projects and programs and reach to these resources. So the GCF today has committed $12.8 billion in 228 projects that have been already approved. And just to mention a number, 59 projects in SIDS, in small island development states, and 61 projects in the LAC region. We have seen that 42% are in adaptation and 58% on mitigation. And they're trying to get this balance between mitigation and adaptation. And this panel brings us to speak about that success, let's say, of the 42%, but how can we make this bigger? Just to mention something really important that links us in this panel as well, is that one of the advantages that has this climate fund is that they give access to different financial instruments. So they have access to grants, to loans, guarantee, and equity. And the nicest thing is when you blend this kind of financial instruments, when you bring a loan with a guarantee, as Joyce was saying, not to support the most vulnerable people. There's not only the grant solution that it's going to make a project sustainable. So combining this kind of financial instruments, I believe that it's one of the most attractive things of the GCF. And the GCF has funded and supported projects that have aimed and enhanced climate resilience in the Caribbean region. I was at that time supporting, and now from the consultancy perspective. And there are multiple different types of projects, but I want to highlight that we have different examples already in the region in agriculture, water management, coastal management, infrastructure, and as well community-based adaptation and solutions. So the GCF has shown interest in supporting projects that promote as well ecosystem-based approach to adaptation. And this ecosystem-based approach involves using nature-based solutions, such as mangrove restoration, coral reef protection, increased resilience in ecosystems and communities. I would like to highlight, Andrew, that one of the main challenges that I saw in the working with the GCF and the different stakeholders and actors is that generally it's difficult for the governments to understand the private sector, that they can also be part of these resources. The GCF has even two windows, one for the public sector and the other one for the private sector, that is called the private sector facility. So it's important that the GCF really wants to attract and find co-financing to the projects and benefit both the public and the private sector. This is something that it's a challenge, of course, in the Caribbean region, but there have been a lot of interest, for example, in helping development banks to give access to private and other public banks so they can be implementing this kind of resources. And we know that for SIDS and the Caribbean, time of economic downturn and even recession of a lot of the countries after post-COVID has been a terrible consequences economically. So governments that have a very key role in the GCF through what they call the national designated authorities, they can borrow these resources, access to these concessional funds, and spend them in sustainable climate projects, helping to promote and stimulate the economic activity and the business in their countries. So accessing these kind of resources, co-financing with other sources of finance that could be international, regional, or local, they can benefit the private sector economy, help to boost the demand, investments, and promote the creation of green jobs, among others. So I believe this kind of climate funds, and it's not the only one, a lot of us, we know the Adaptation Fund, the GEF, the CIF, but they are these different as well needs of coherence and complementarities. You know, sometimes the governments just ask not to one fund and they're doing something similar with the other one. They're doing it with a multilateral bank or bilateral support from another country. So how can we articulate in this kind of panel shows, bringing different expertise and experts together with the same oriented objectives to really help the vulnerable to access to the resources and not just only those that can access to the information and have that generally more accessible. So with that, I don't want to take much more time because I know I have 8 minutes sharp, but I'm happy to follow the conversation. Thank you, Andrew.
Thank you so much, Jessica. And you stayed right on time. So thank you for that. And I really appreciated how you helped unpack the Green Climate Fund, or GCF, for today's audience. And if you'll permit me, I know this was the opening remarks, but I have a couple of quick follow-up questions that I'd like to ask you. The first is about the direct access entities that you mentioned, which are really one of the fairly unique features of the funding mechanism of the GCF, whereby local financial institutions directly in the markets that the GCF is trying to help are able to access the funds without going through other financial intermediaries. And I'm curious if you could talk a little bit about how the direct access entities and the projects that you've worked on in the LAC region have potentially been able to better tackle these issues of inequity, particularly in resilience, by virtue of being direct access entities.
Thank you, Andrew. Well, the first thing that I would say, and that was one of my, I don't know, sometimes people take it wrong, but one of my revolutions within the GCF, it was really how to help these direct national and regional entities first to get accredited. And one of the tips there is that sometimes those that want to do too much too fast, you don't reach never to that goal. So it was, how can you get this accreditation with really those standards that you really know and you have the experience, no? So depending, for example, for a financial institution, no, they might want to do directly and get accredited to loans, to guarantees, and to equity. But if you don't have that track record, if you don't have all the policies and procedures in place, start with loans, that it's your core business, and then you can improve. And one of the great things of the GCF is that they have this readiness program that it's to build capacities, and direct access can access this readiness program. So we did that with a lot of direct access, mainly the national ones, for them to get accredited for 1 or 2 financial instruments. For example, to category of environmental social safeguards, maybe C, no, low risk, maybe B, middle risk, and then they increased and what they call, they upgraded to other categories. So first try to be realistic. And through that readiness program, it was key for multiple national and regional entities to strengthen their capacities, not only internally, for example, to develop and implement a gender policy, but as well to develop projects and programs. Unfortunately, and that was the reason why I created Sureco and quitted the GCF, is because I realized that each time that we were doing a project or a program supporting either the government or the accredited entity, they always ask, Jessica, do you know good consultants, but that they are from the region, understand our local context, our community, even sometimes our own language. No, they had Brazil, for example, they say like, I have a lot of Germans and Canadians consultants, they don't even speak Portuguese. No, so how can we develop good quality projects with consultants that have never even touched South America or the Caribbean? So that was one of the things that motivated me the most to bring this, this group of these rosters of good talent of consultants and even firms, because this, I always say, this pizza is too big to share. So we have to work together as a collaboration, all with that aim of making these projects a reality so that we can attract the resources and really channel them through the development of the projects to local entities. No, these kind of big projects, no, I don't have nothing against international entities, but sometimes they don't understand this local context and which could be the best partners to really channel the resources and get to the final beneficiaries. That is what we all are trying to scale up and to make better than just getting the resources, not to a ministry and high-level institutions, but we don't see how they're reaching to the ground.
Yeah, I think you make a very compelling case that there needs to be an entire ecosystem of support for this local capacity that really is necessary for the finance to flow directly to these local institutions and to reach the communities. One other question before we move to our next panelist. you mentioned that 42% of the GCF projects are in the adaptation space, but you also mentioned the private sector facility. My understanding is that the share of adaptation projects in the private sector facility may be lower than that, and it's often more challenging to come up with sustainable financing models with private sector participation focused on adaptation and resilience, and of course, disaster preparedness and response, the topic here. And yet, the GARI group and many of our audience today are from the private sector. I'm curious if you could speak to where you may have seen some traction, right? Where were there innovative projects that both addressed adaptation and the private sector's participation?
Great, Andrew. Yeah, unfortunately, that has been a challenge for the GCF and for this division of the private sector facility. First, starting again by the accreditation process. A lot of the accredited entities focus more on supporting governments than the private sector. So you have already that bottleneck. You need more entities that work with the private sector accredited to benefit this sector. But a few, for example, investment and equity funds had finally got accredited. One of them, for example, is Pegasus. And they, for example, and I supported at that time to develop the first at-scale private sector program in blue economy, that it's called the Global Fund for Coral Reefs Investment Window. And they created a private equity fund to encourage investments in blue economy. And that includes ecotourism, like resilience infrastructure, sustainable infrastructure, water management, ecosystem-based solutions, among others. This fund managed a total funding of $500 million USD, and they got resources from the GCF on equity of 125 million. So this is one of the best examples at the moment, and one of the first of the GCF of a massive equity and in a difficult sector that it's the blue economy and adaptation, and they are benefiting more than, I believe, 15 countries, mainly seats, or that they have a very important blue region on their geography. So that's something that it's interesting. Now we hope to see what are the kind of investments that they are going to do with those resources, and hopefully they could even reach to all of these people to ask for additional support and advice, because we need this collaboration among different entities.
Well, thank you, Jessica. That is a great segue, this discussion of the public-private sector interface to our next panelist. So without any further ado, let me introduce Lisa Davis. Lisa is responsible for developing and leading PGIM or PGIM Real Estate's impact investing strategy, including the creation of a new impact investing fund. Most recently, Lisa was Director of Investor Relations and Specialty Originations at Pembroke Capital Management, where she raised capital from institutional investors for commercial real estate investment, primarily focusing on affordable housing and community development. Before joining PGIM Real Estate, Lisa spent 6 years at the Ford Foundation, where she made grant investments in affordable housing and community development. Prior to that, Lisa spent 12 years doing commercial real estate development in Boston, first with nonprofit community development corporations, and then with the private equity firm New Boston Fund. She led the redevelopment of some of the most significant publicly owned sites in the city. Lisa started her career in Texas and the Bronx as a community organizer and advocate of housing and homelessness issues. So, Lisa, you have a fascinating background spanning both the public and private sector, really centering equity through issues of housing and real estate. Would love to hear more about your experience in this space and how you think about investing to embed equity.
Great. Thank you. It's really great to be here. I appreciate the opportunity to be on the panel with these amazing women and to talk about private investment in this particular topic, because I think it's not, private investment is not always the door in for most people, but it's such a huge and important part of being able to finance equitable disaster preparedness and recovery. So I'm going to talk about two parts of my experience, one at PGIM Real Estate and one at the Ford Foundation, with regards to creating equitable, disaster resilient real estate and equitable disaster recovery. So PGIM Real Estate is the third largest real estate manager in the world. We have investments in the Americas, in Asia, and in Europe. And just to give you a sense of the scale, we probably own 1 million apartments around the world. And a good number of those, in the tens of thousands, are affordable to low and moderate income people. We are a fiduciary, so our investors are looking for financial return. They are largely corporate and public pension plans, also foundations and endowments, and increasingly, high net worth family offices kind of investors as well. So as we think about disaster resiliency, a lot of it for us is about protecting against physical risk. And just to give you a sense of how that works for us, we red flag rate all of our investments for major climate risks using 427 data and Munich Re. And then we use that information to improve the resilience, the physical resilience mostly of our investments. I want to make a note here that while we have access to the best data in the world, I think, and it's based on a number of different factors, including scenario planning, that data, in my opinion, still does not include an adequate basis in equity. It doesn't look at interdependencies that impact low and moderate income communities disproportionately. And it assumes that everyone has the same kind of risks with regards to climate events, both chronic and catastrophic, and we know, in fact, that that's not the case. In addition to sitting on the ESG team and working on some of this, larger scale resiliency preparedness, I run an impact fund, Andrew, as you mentioned, that invests in affordable housing in the United States. And I think maybe we'll talk a little bit more about this later in the conversation, but I think that building, owning, maintaining resilient, affordable housing is one of the most important ways that we can create equitable disaster preparedness and resiliency. And spoiler alert, that resiliency is not just about the physical resiliency of the property, it's also about how do we help our tenants to be more resilient, and how do we help communities to be more resilient. And there's lots to dig into there. Before I came to the Ford Foundation, before I came to PGIM Real Estate, I worked for the Ford Foundation and led a grant making and investment initiative that was very much focused on how do we direct disaster recovery dollars to benefit low and moderate income people in the United States. In the US, the disaster recovery dollars that are available are legislated to disproportionately benefit low and moderate income people, but in practice, that is not the case. And at the Ford Foundation, we supported several civil society groups that were studying this and raising political awareness about this, and then worked with some legal advocacy groups to actually go after the local authorities in New Jersey during Sandy and in Texas and Ike and Dolly that were inappropriately allocating those dollars disproportionately to higher income communities when legislatively they were required to go to lower income communities. So, there's a really important role, I think, for civil society there in making sure that the commitments that are made on the behalf of governments are carried through, and that low and moderate income people receive the benefits that they pay for, that they deserve, and that they need in the face of disaster recovery. The other element of disaster recovery that we worked on and that we supported local communities to do when I was at the Ford Foundation is really about how do you make the plumbing of disaster recovery work for low and moderate income people, particularly for low and moderate income people that may be in irregular housing on the US-Mexico border, for example, who may be disproportionately renters, who may be disproportionately uninsured. And the whole way that low and moderate income people access those dollars, those resources, needs to change. And so we supported some local groups. And Jessica, back to your point that it's really all about local capacity. We supported local groups that were creating better processes for obtaining disaster recovery dollars and utilizing those to repair homes and to create greater community resiliency.
Thank you, Lisa. Wow, that was a lot that you packed in there. There's a lot for us to explore. So a couple of follow-up questions of things that I picked up on. First is this issue of data, right? And there is a burgeoning climate risk data industry that has been growing quickly. I, in my day job, work a lot in that space. And I think you've really put your finger on a bit of a blind spot. The fact that equity and vulnerability is often not really integrated into a lot of the tools that are out there, which are very good in many respects and very powerful. And yet there's a lot of room for improvement. Could you expand a little bit on where those inequity and vulnerability overlays can come from to compensate for that, whether it's you as a user of those tools or your advice to the community of data providers? What should they or could they be doing better?
Oh, that's a really complex question, Andrew. I'll try and.
Oh no, I was hoping to give you something a little more straightforward. Well, maybe there's a way we can cut it down to size
I think
for a minute or two.
So why don't we start with infrastructure, right? Like we know that if you have an address and you pull up your scenario data for that address, it spits out some risks for you. But those risks don't necessarily account for the differential in disaster resiliency infrastructure at that location. So for example, we know that low and moderate income communities have more poorly built and maintained flood prevention infrastructure. That in some cases is by design, but you're not going to know that by looking at your 427 data, really. That it doesn't connect that infrastructure to it doesn't connect that community to the infrastructure that it depends on. So if you are in a flood situation and you can't get on the road to get to your job, your probably hourly wage job, you are in danger, not just physically, but you're also in financial danger of losing your livelihood due to the fact that you can't get to your job or childcare or education in a situation like that. And it's harder for you to evacuate because that also costs money, right? So the data at this point doesn't highlight vulnerabilities like that.
Thank you. That's a great example. And I know we could go a lot deeper there. That could be easily be a webinar all by itself, right? But thank you for that illustration and definitely an area for potential improvement. A second quick follow-up is you highlighted your work at the Ford Foundation in really emphasizing the effectively misallocation of a lot of federal funding for disaster recovery that was meant for vulnerable and impacted disadvantaged communities, and in fact what was not going to those most vulnerable and impacted communities. Could you briefly touch on a little bit of the dynamics at play there of what were the forces causing that to happen, and how can civil society be a better watchdog or try to sort of change whatever underlying institutions are creating those dynamics?
Yeah, I mean, I think when a disaster happens and the federal government needs to get money out, it is likely to go to the easiest and most ready organization to get that money out the door. And so the lack of capacity that exists in low and moderate income communities and in civil society in these locations is also part of the challenge in getting some of those federal dollars out the door. So, it all comes back. The most dangerous element of climate disasters is poverty. People are suffering from the same inadequate institutions that exist in low and moderate income communities. And so supporting those institutions and supporting civil society in those locations will help to improve the ability of disaster dollars to flow to those communities.
Great. Well, thank you so much, Lisa, for emphasizing that there are a lot of structural issues at play, and a lot of those underlying poverty and low capacity challenges in those communities, in fact, reinforce the inequality of disaster recovery funds flow. So thank you for that. Let me now introduce our third panelist, Lauren Burnhill. Lauren is an expert in sustainable finance and has more than 25 years of experience in launching, advising on, and managing emerging markets impact investment funds and sustainable development finance transactions worldwide, with emphasis on appropriate financing for inclusive growth and resilience. Her expertise includes gender equality and social inclusion, global climate adaptation and resilience investment, and inclusive micro, small, and medium enterprise finance. Lauren currently serves on the boards of Just Share South Africa and Shared Assets UK, and is an independent investment committee member of the Helenos Foundation, an impact private equity fund that invests in financial institutions serving micro and small businesses in Europe and the Balkans. So Lauren, thank you so much for joining us today. And I'd love for you to share some of your experience from the impact investing space and working with small and medium business.
Sure. And, I want to say, listening to Lisa, it really struck me that our failures to make disaster relief equitable and inclusive is how physical risk becomes transition risk. But we can get to that later. In the interest of time, I don't want to talk a lot about my background or practice. I want to draw examples in to what I'm going to say to try and get you really passionate about coming down into the weeds with me. But I do encourage everyone to connect with me on LinkedIn if you want to know more about anything I say or how your organization can act on any of the finance-enabled solutions that I'll be sharing. So I want to start by saying, according to Oxfam, by 2030, an estimated 86% of people facing extreme poverty will live in the most fragile places on Earth, affected by climate crisis, armed conflict, violence, and disaster. In the organization's recent Decade of Impact research report that covered projects they executed around the world between 2011 and 2020, they found that 70% of projects working toward community resilience achieve positive impact. And their overall takeaway from their findings, it reinforces the need to work on addressing longer-term structural and political causes of instability. So in the context of climate change, that means increased emphasis on adaptation and resilience over mitigation, and importantly, on ensuring that the benefits of those efforts are inclusive across gender, age, income, and geographies. So the definition of climate and disaster-related resilience is the ability to prepare for, recover from, and adapt to the impacts of a disaster. Marginalized communities and individuals are less likely to have the resources available to build their adaptive capacity, and that means that the impact of disaster-related harms affects them more acutely. If you don't own or can't afford a cell phone, you're not going to receive an SMS weather alert, even if that system's put in place. And for those who don't have access to cool air or water, a heat wave can have a fatal outcome. Little or no savings means no funding to recover. Farmers can't buy new seeds or to plant or other key inputs. Small business owners can't replace lost merchandise. Post-disaster increases in food prices push increasing number of families into food insecurity and hunger. Where climate-related disasters lead to forced migration, those with few resources find themselves with nowhere to call home, no livelihoods, and no agency over their lives. So climate refugees face an additional level of difficulty in recovering from disaster. The inability of large chunks of the population to recover from disasters impacts the economic bottom line for everyone. Small businesses in the supply chain go under. Crop failures reduce food supplies, leading to food insecurity, food scarcity, and inflation. Workers drop out of the labor pool. Tourism and hospitality industries are decimated. Inclusive adaptation and resilience, helping people to prepare for, reduce the potential harms of, and recover from climate-related disasters is not only a moral and ethical imperative, it's necessary to sustain economic growth and productivity. So, what can finance do to help foster more resilient post-disaster outcomes? Really, there are two intervention points: pre-disaster and post-disaster relief. And there are investment and financing opportunities across a range of asset classes and geographies. So finance-enabled solutions pre-disaster. Let me start with climate tech and insurtech. Climate index insurance tied to vulnerable microfinance loans can increase preparedness and ability to recover. And here we can look to credit life insurance and microfinance as an example. In Peru, after the 2007 earthquake, microfinance clients of organizations that required mandatory credit life insurance built back better and faster than uninsured peers. I happened to be sitting on the board of a bank that required mandatory credit life, and we were, let's say, pleasantly surprised to discover that past due loans and defaults remained quite low despite the extensive damage. And yet at that time, it was considered controversial to require that credit life insurance. For agriculture and rural communities in particular, parametric weather insurance and group policies through community organizations can reduce delivery costs and speed payouts post-disaster. And here's the thing, many of these climate and insurtech solutions have been around for a decade. What they need now are opportunities and financial structures that enable scale. Banks, and I would say in the US, probably CDFIs as well, banks can actively use digital technology to reduce the cost of acting as government social payment agents, serving often unbanked people. Campaigns to bring the unbanked into the financial system, if done with the intent to increase resilience, can attract new subsidies and build positive reputation. And those banks that already act as social payment distributors can step up their outreach in climate vulnerable geographies, because the more people who are digitally financially enabled pre-disaster, the easier it is to reach them and support them post-disaster. So moving on to those post-disaster and disaster relief solutions, tech-enabled disaster relief payment systems that channel public sector aid payouts can be powerful. This isn't just limited to banks, but the banks that have already built their social payment distribution systems have a huge comparative advantage in channeling disaster relief funds. And there are innovations around biometrics and blockchain tech that can improve security and regulatory compliance when it comes to distributing disaster relief funds. We can leverage the post-COVID experiences, positive and negative, in the US, UK, and EU, to look at build back better type loans for small businesses. So banks can, not just small businesses, banks can offer loans to NGOs as well as small businesses that support the community, providing resources for working capital, job creation, and job protection. Governments, and in some cities and regions, private philanthropies, can support these schemes, enabling the banks to offer uncollateralized loans, lower interest rates, and grace periods before principal repayments begin. And those loans can also be conditioned around use of proceeds that require or favor climate adaptive recovery. Last, but by no means least, blockchain-enabled fintech solutions can help meet the need for refugee finance, climate or otherwise, ranging from simple, such as Revolut's waiving certain foreign exchange transfer fees for Ukrainian refugees, to more complex schemes that enable people to convert home currency funding to digital currency before departure, or to transfer credit history information to a secure global digital platform. Classic risk-return trade-off methodologies tend to overstate uncertainty risk and undervalue somewhat intangible returns like workforce stability and economic recovery. Financing inclusive adaptation and resilience means developing a more nuanced understanding of both risk and impact. And I'll talk about that more when we get to our call to action in a short while. Thank you.
Thank you so much, Lauren. Well, that was very pithy in terms of really introducing a number of specific strategies and solutions. And so really, really helpful to touch on, particularly those tech-enabled solutions. We're going to hear from Mitch in the second half of this recorded statement on some of the InsurTech solutions. So I want to leave those aside for the moment. But I did want to follow up on some of the post-disaster technological innovations that you were talking about, particularly to reach vulnerable and less banked or unbanked populations. Could you perhaps give us an example or two of ways that these technologies have actually been used in post-disaster situations from your experience?
So, and it really does depend on the kind of disaster in a sense, because flooding is going to have different conditions on the ground, literally, than a hurricane that comes through and leaves disaster in its wake, but not necessarily wipes out everything or leaves everything underwater when it passes through. So there are quite a few interesting examples. There are, so in aid relief agencies and in others, using cards as the digital vehicle for carrying money and bringing in kiosks that enable people to do what they need to do digitally without having to bring bags of cash. Now, mind you, I actually know people who have carried bags of cash to disaster sites in previous years, but a secure digital technology that is portable can have a much greater impact in the long run. Some of the, I guess, it's not really finance enabled, but including gender, quite intentionally in disaster relief distribution schemes has a strong economic effect, because quite often, particularly in agricultural areas, but even in cities, in urban areas, the women are both responsible for the family health, nutrition, food, water, but they're also running businesses on the side. And when disaster relief only goes to a male who may or may not be head of household and may or may not be located with the household, the woman's small business and her family suffer. So her ability to contribute to the economy, to keep the children in school, there are actually interesting studies that show that $1 of disaster relief given to a woman actually produces more impact than giving $1 of disaster relief to men. The use of biometric technologies. So in a lot of places, you don't necessarily have a national ID number or a social security number. How do you identify that the recipient is meant to be the recipient? There's obviously a big issue of signing people up on the spot. It's much easier if, as I mentioned, the bank's already distributing social payments and there's a mechanism. But there are, actually all kinds of nifty handheld devices now where you can scan a fingerprint. So you're out in the field, this person needs money, give me your fingerprint and a name. They don't even necessarily have to be literate, although that's nice. And you can get them into the system and channel payments in a secure way. Seems simple, but it does create an investable business, particularly in rural areas, but even in urban areas. Lower income sadly corresponds to lower education, which means fewer opportunities for people to learn the dominant language, whether that's English, French, Spanish. So there's quite a lot of, and depending on the country, it can be very many ethnic, tribal, indigenous languages, and the ability to really cool voice tech that can provide in local languages the information you want to communicate using digital tools, using voice blast instead of text messaging with their phones. Really fascinating and creative things that can be done. And just to touch on the issue of cell phones, in the US in particular, like everybody has a cell phone, everybody has 2 cell phones now. But in much of the world, cell phone ownership either isn't as pervasive, or it is where it is present, it's present in the male population. So bringing, and Grameen phone has done this to a large extent in the countries it's operated, but bringing a phone into a community and setting up a woman as a small business because she's got the phone and everybody can come use it. And she receives the text messages and communicates that information, actually turns out to be a really interesting economic opportunity. And it can help overcome some of the access barriers. Although PS, I have been informed that where the women don't have cell phones, quite often the male children have access to cell phones. And one way to increase digital inclusion and literacy is to make sure that we're including younger people into the outreach, not just adults.
Very interesting. Well, I really wanted to follow up specifically on this question of gender inclusivity and equity, because that clearly is a huge element in the inequity of disaster resilience and recovery, as well as many other economic opportunity inequalities that we see. You mentioned biometrics as helping to address that. I guess sort of some of these dynamics around outreach, around working with groups. Could you speak a little bit more about which of these emerging fintech solutions in particular help to reach women to address gender inequity?
Well, I'm not sure so much that it's which solutions as which organizations, because there's really a cultural and mindset issue here. It's you have to want to reach women to make an effort. But recently I was doing some work in Southeast Asia with women SME entrepreneurs, and some of the non-bank financial institutions that we were talking with took the time to go out and speak with females, not only those who are clients, but those who weren't clients, to say, why aren't you using our digital platforms? These are really powerful tools. You don't have to go to a bank branch, so you don't need a male relative to accompany you. Why aren't you using them? And one of the issues was that the language, not the actual language, but the terminology being used in these digital tools was directed toward the way men tend to think about and use financial instruments, which was different than the women in these cases who may be quite competent and used to managing family budget and complex transactions in the marketplaces, but they're not thinking necessarily about interest rates and fees. And in order to get information to them about those sort of things, it has to be shaped in a way that will be accessible, and also not talking down to them, because they may not be doing digital banking now. They may not be used to formal finances, but informally, they do have a lot of financial skills that they apply in the household, and they have dignity.
Well, thank you for sharing that. There's a lot of intentionality and I think effort that needs to go into really understanding these target groups better, right? And make sure that one size fits all approaches don't end up leaving certain groups short, whether that's intentional or otherwise. So thank you for that. I think this is a good juncture. Joyce, if I could call on you to queue up the second half of Mitch's video, and we can then move to the discussion. Give
you a brief example. Here in the Philippines, where I come from, we have several initiatives to address this gap and this inequality. We have, for example, the Philippine Catastrophe Insurance Facility, which is morphed into two work streams. First, a pooling mechanism designed to increase the capacity of local insurers to write NatCat insurance, and to use the increased efficiency of a pooling mechanism to get better terms from the international reinsurance market, therefore benefiting the insuring public. The other is a new product designed for precisely the underserved portion of the population. This is a micro-insurance product containing both an indemnity-based and a parametric cover, therefore allowing a quick payout post-disaster and therefore a quicker recovery. It is a micro-insurance product which accordingly allows access to those who cannot usually purchase traditional insurance. We are on the road to rolling out both of these initiatives despite numerous setbacks. One very important realization is the need for an all-of-society approach. The more of us who realize the need for a particular solution, and the more of us who realize the need to be on the same page, paves the way towards a quicker resolution. This then highlights the importance of this event, an opportunity to share ideas, an opportunity to vicariously learn from the experience of the others, and an opportunity to meet people or groups who may be able to ease our own journey towards protection and equity. Thank you all, and may we have a fruitful exchange.
Thanks so much. I'd like to now turn to our Q&A session and come back to Jessica for a moment. We've just heard from both Lauren and Mitch about thinking more creatively, innovatively, and deeper to reach many disadvantaged and hard to reach populations, let's say, right? Particularly those that have been neglected by the private sector or where the private sector isn't active. And Jessica, I know you have a lot of experience working in SID, small island developing states, which really, I think, fit that description in many cases. Could you tell us a little bit about your experience working with the GCF and the Caribbean Development Bank to embed resilience in development finance and expand blended finance for resilience, specifically in SIDS countries?
Thank you, Andrew. Maybe let me ask to answer that example with two, okay? So I'm gonna take a little bit more because I wanted to follow up on Lauren's point on the technology, that it's fundamental. And as she was speaking, I thought about a great example that I wanted to share. It's not the end or the best, but it's at least a good effort. It was something that with Sureco, we collaborated during the past COP. And it's an agreement between the Caribbean Community Climate Change Center, that it's a regional direct access accredited entity to the GCF, the Blockchain Institute, and Climate Coin, that it's one of the hopefully first climate currencies worldwide. So they are collaborating together. This is for the Caribbean region as a pilot to do some capacity building, mainly on applications of blockchain and cryptocurrencies and other technologies for local climate actions. So something that they're looking, it's on, of course, this capacity building to make the Caribbean and different institutions understand the value of this kind of technology, but how to make something even more innovative, as you were saying, this kind of new currencies that, for example, this climate coin, each climate coin is 1 ton of CO2 that is certified and exchange on the voluntary carbon markets. But how, for example, resources that are moving so quickly on carbon markets could go not only to benefit from the mitigation process, but to be invested on the adaptation. So how can we do this cross-cutting effort on bringing where it's easier to attract resources, that it's on the mitigation part, but taking at least a piece of that to be reinvested on adaptation. So I really like that example, and I wanted to quickly to share with you. On the one that you asked on the Caribbean Development Bank, I worked for them, and I was hired by an international consultancy to be the project manager of developing a full funding proposal. So that was even after the GCF. It was more as an independent consultant to help them develop the funding proposal and all the annexes that are needed for a project that it's called Transforming Finance to Unlock Climate Action in the Caribbean. It's a project that would be started with 3 countries, Belize, Jamaica, and St. Lucia, but the intention is hopefully that it would be scale up to other countries in the Caribbean region. This program, it's aiming around $70 million, and it aims to unlock the private sector investment that it's needed to transform the tourism sector and the energy systems related to the supply chain of tourism and their infrastructure. And then this program, normally what wishes to accomplish is to bring blended finance from the GCF and co-financing from the Caribbean Development Bank. And these resources will be channeled through concessional lines of credit and other instruments to the development financial local institutions. And these development financial institutions finance private banks, no, or financial institutions, so who will return it into all this sector. Something that I really believed I brought value to these projects are two things. It was focused at the beginning on general like agriculture and then energy, no? And I realized that, and you know that the Caribbean and mainly sees a big part of their GDP, it's around tourism, no? And after COVID, it suffered a lot. So how we could link, no, all these sectors, and not only agriculture and energy, but resilient infrastructure that was missing, and it was a key part of it, around the tourism sector. But something in addition that I tried to make very openly revolutionary oriented, and it was kind of the mandatory things for me to accept that that proposal of work, is that it had to be focusing on just medium and small enterprise. No, we cannot go and give this kind of blended finance to the big hotels of the Caribbean that they don't even, no, they are even invested from the US and others, and they have their own resources. No, so we should make clear that these resources are really going to target the tourism sector, but for example, the small restaurants, no, the food chain that could support better the supply of the hotels, no, the resilience of small hotels and no, and little businesses that are moving around this this tourism sector. So hopefully this project is gonna get approved this year within the GCF. But just to be very honest, and hopefully that client that I'm not mentioning is not going to hear this conference, but I decided for personal and professional reasons to leave the project because it was an international firm, and the main consultants were all foreigners, no? And I said, like, we have to bring these consultants into the ground. They have to go to Belize and Lucian, Jamaica, to really understand the sector. And honestly, that it's what inspired you. You have to understand the local context, their needs, speak to the woman, no? As Lauren and Joyce are very open, and Lisa too, into this important matter. And then we can really bring ideas into the project. Now, for example, something that I really appreciate as well from the GCF is that they have this mandatory gender policy, and it's not just not half and try to reduce the imbalance, but you have to put resources from the GCF in activities that will reduce that inequality. No, so if you don't go into the ground and you don't speak to these women, how are you going to bring up from your computer true solutions to this gender balance? So that was the reason, but I think I added a lot of value, and hopefully the project is going to get approved. And I believe it's going to be a paradigm shift, at least starting with 3 countries.
Well, thank you for sharing that example, Jessica. A couple of things that I picked up on that you highlighted. One is that sometimes there are sectors or social structures that are effectively hiding in plain sight, right? Like the tourism sector in these countries that sometimes go neglected, but are a tremendous opportunity, both for reaching target beneficiaries, but also for mobilizing private capital. So I think that's one really important point that you raised. I also really like that you focused on the importance of targeting, right? That it needs to be very targeted to ensure inclusivity of women and of small and medium business. Otherwise, it will just go to a lot of the big players. And I think that's a great segue for us to come back to you, Lisa, given your work on affordable housing and both that importance of a critical sector for addressing resilience and reducing vulnerability in housing, particularly affordable housing, and targeting those most vulnerable is really critical. And I was really have been looking forward to revisiting that part of your opening remarks. Can you tell us some more about your work in affordable housing?
Sure. I'm so struck by how much of this conversation has been about social and financial resiliency instead of physical resiliency, right? We could have spent this whole conversation talking about how do we get better flood infrastructure in poor communities, and how do we, make sure that our chillers are on the roof, so if there's a flood, it doesn't, people still have air conditioning. But instead, it's so interesting to me that we've spent most of this conversation talking about financial fitness, if you will, financial access, banking access, and who gets the dollars, and community resiliency. So I just want to point that out, and that's part of what we think about in the Affordable Housing Fund that I lead as well. That resiliency, we build resiliency not just by having strong physical structures, but also by having strong resident services programs. And our resident services programs have a lot of the same elements that Jessica and Lauren are talking about at their core, in terms of helping people to connect to mainstream financial systems, helping people improve their ability to save and have reserves for disaster situations, helping people improve their credit scores so that if necessary, they have access to credit in these situations. And then also, you know, helping people to connect to their neighbors. I think we know that in disaster situations, neighborhoods that have a higher social capital, higher social connection, are more able to take care of vulnerable people because those vulnerable people are connected to their neighbors. And I think this is really this social aspect is really an important part of equitable resiliency as well.
Thank you so much for that. Lauren, I wanted to also on this topic come back to you for a moment on this issue of specifically targeting small enterprise, right? I know you spoke to that a bit in your remarks and your examples. I think that Jessica really did a great job of highlighting how important it is to structure projects around small and medium enterprise. And I know you have done a tremendous amount of work in that space. Could you share with us a little bit of your playbook of how you work specifically with that segment?
But first I need to reassure Jessica, I have worked in 45 countries, been in 83 countries, and I work in 5 languages. So not everybody on the international side is stuck in where they come from. So, you know, and this is really kind of low-hanging fruit for institutional investors, but the way to reach the smallest businesses is through financial institutions. And that doesn't need to be microfinance institutions. It can be through regulated commercial banks. Obviously, when most of the businesses in a country are small businesses, and it is quite often something like 90% of the businesses are small businesses, those are who the bank's clients are. So credit lines to the banks that come with appropriate conditions, requirements, and even technical support can really help target money. So saying SMEs, but then looking also at the sectors where small businesses are important, goes without saying, excluding related party lending. So it's not just going to the relatives of the bank owners. Looking at incentive structures in the credit lines for reaching higher numbers of target populations, whether that's women or youth or rural areas, and helping incentives to flow through. So it's not just about encouraging the bank to do more climate lending or gender lending or SME lending, although it is, but you can encourage them to pass on to their borrowers incentives. So for example, companies that take green loans for increased energy efficiency or increased water efficiency can get a lower fee on their loans, or a lower interest rate, or some kind of payment at the end of the loan for completing it successfully. The structure of how money flows can really have a big influence in where it reaches into. So, and the other way to get to maybe even slightly larger businesses, of course, would be to invest in the funds, impact funds, venture capital funds, private equity funds that are investing directly in locally owned businesses. And frankly, I would point you in Africa to the Collaborative for Frontier Finance, which works exclusively with local capital providers focused on SMEs. Those funds get the least resources, the least attention, really have to make do on a shoestring, but they're on the ground, they're reaching these businesses and being able to support them, you know, it probably coming from the tiny alternative investment bucket you have if you're an institutional investor, but it can have an awful lot of impact and not just in the businesses it's financing and the people they serve, but also as a demonstration effect for other investors, that there are ways to do this.
Yeah, and I guess one thing I might add from, a larger private equity player perspective, the types of interventions, Lauren, that you're talking about make tenants in our buildings, business tenants, just better able to pay their rent and, support our fiduciary role in managing capital, right? So if tenants are more disaster prepared, they're probably more financially stable. That also contributes to the financial stability of the properties that we run. So there's there's sort of a dual benefit there, not just for disaster preparedness, but also for improving the overall financial resiliency of large institutional investors.
I think that's a really intriguing point, Lisa, that this is not just something that has to be pure altruism or the purview of government or public investors that are considering these things. There really is a often, in many cases, not in all, of course, a core fiduciary or financial incentive for thinking in these terms about addressing vulnerable communities, and that's a theme that I see reemerging in my work on climate risk. And that leads me to a question that I want to first direct to Jessica, though any of you may wish to answer, which is, what does the future look like of climate capital flows for equitable disaster resilience? What do we see as some of the trends, whether they're coming from the big climate funds like the GCF, or whether they're coming from private sector players like PGIM or the impact funds that Lisa and Lauren are working on? So maybe Jessica, if you'd like to tackle that one first, please go ahead.
Yeah, well, I will tackle it from the international perspective. And speaking about funds, of course, the GCF, it's aiming not to reach always this balance between mitigation and adaptation. And from the past two COPs, the governments are putting a lot of pressure for them to finance more adaptation projects and involving the private sector. But in the last COP, one of the, I don't want to be very negative, but one of the few things that came out of Sharm el-Sheikh, where I was present, it's this announcement of the creation of the Lost and Damaged Fund. And again, not to be pessimistic, but having been part of all this building, structure, operation of the GCF, it would take a lot of time. And it's not only to how it's a great challenge to make these funds operational, but in this case, I see an additional huge challenge, and it's how the countries will agree to allocate resources to the fund. We know that the GCF, it's based on just pledges from the developed countries. In this Lost and Damaged Fund, there's a lot of pressure to the developed countries that have had more emissions and impacting the planet to contribute more. Of course, they don't want to have that responsibility. How do you account for that responsibility? So yeah, being very honest, I think it's going to take a lot of time. And unfortunately, it's kind of the hope of developing countries, and mainly seeds and LDCs. So I would put my hope in taking that fight, but bringing other fights into it. And I think that one of the ways, it's what this panel is about. It's bringing collaboration from the private sector with the governments, working closer together, and hopefully that would make a big difference. And speaking about financial institutions, I think that unfortunately for them, and lucky for the others, there are more and more regulations are going to force them. If you don't want to invest on this kind of investment, you will have to. And if not, you're going to be judged on your risk assessment, on everything related to these matters of sustainability and climate change. So hopefully they will open their eyes and be more proactive without the needs of regulations. But if not, I'm really sure that it will come more and more, and everybody, the planet has to, private or public, align into this goal or I don't know what's going to happen for my 12-year son. So hopefully something that we will all continue. And I'm more than looking forward that after this panel, we can continue the collaboration and think of ways of practical collaboration between all of us and even some of the participants in this event. Thank you.
Thank you so much, Jessica. Well, you've really preempted my final question for the panelists, for all the panelists, which is a call to action. And so maybe I see, Lauren, you're ready to jump in. So
Yeah.
please have at it.
Because I wanted to continue this issue of trends and where our financing flow is going to go. And it actually gets to the question you want to as well. So yes, regulation is a driver. Green taxonomies have been a real driver in promoting climate finance flows around physical risks, because they very clearly define the physical risks in different sectors, which makes it easier for investors to know if the needle is moving or not. And the next challenge, and I'm going to say the next trend, comes from transition risk, because there aren't social taxonomies at this point. There are emerging social standards and practices, and the UN SDG framework increasingly helpful, but socioeconomic risk and social risk in particular are huge parts of transition risk. And you see something like, a flood in Pakistan leads to food riots, but it also, the export crops go down and you end up with price inflation and hunger in the UK, and they have to build, create emergency food banks to address it. So to deal with transition risk and this, trans-border risk, whether it's between states or countries, we are going to get to more adaptation and resilience financing, one way or the other. And one of the exciting projects I worked on, another shout out to the GCF, but this project has now been improved, is a global climate finance platform called Gaia that was set up. It's a multi-stakeholder project that was set up to make it easier for institutional investors to support climate finance. It's meant to reach both the public sector stakeholders trying to fulfill their NDCs and their partners in projects. So there is Green Climate Finance Fund funding, but the largest asset manager in Canada, Canada's development company, development finance company, FinDev, one of the largest Japanese financial groups, which is an accredited entity. And they didn't just put together the platform. Okay, they did have to do I was part of the gender equality and social inclusion pillar for that. At the platform level and in every project, there are clear targets and benchmarks and indicators. So all of the money, and they're targeting initially $1 billion of financing in 5 years. All of that money has to include the social inclusion as well as the physical risk. And there are components to that project that are dealing with the foreign exchange risk, with the capacity building. And I think we will see more and more of these solutions that make it easier for institutional investors to invest in adaptation and resilience and achieve the impact they want without having to figure out for themselves how they determine gender success or not.
I mean, Andrew, my big takeaway from this is that we need to make sure that the social and financial resiliency of disadvantaged and low and moderate income communities are part of the taxonomy and the considerations of resiliency. We have a tendency to go to physical risk because that's technical and we can talk about it, but we need easily in a lot of different contexts, but we need to continue to make this social and financial resiliency a part of the conversation in taxonomies as well.
Short and sweet, I really like that. So we are just about out of time, so we could go so much deeper, but I think we need to bring things to a close. So I will pass the floor back to Lori to close us out.
All right, well, great. Thank you. What a fantastic discussion. I put in the chat, but we ran out of time. Would love for the panelists and also just for all of you that are listening to think about, how can GARI and the GARI network help further some of these objectives. GARI is all about knowledge management and collaboration. So to the extent that GARI can play a role in helping raise awareness and understanding of these issues, that would be very, very interesting. I just want to thank Joyce Coffey from Climate Resilience Consulting for initiating this event and bringing in our panelists. I want to thank Andrew Isle at Tata Consultancy Services for doing a fantastic job. As usual, not that we necessarily expect it, but we expect it. He's always does a great job of like really listening to what people are talking about. Lauren, Lisa, Jessica, Yazid, thank you all for being here and participating in this. Thank you to Brian Parham from GARI and the Lightsmith Group for helping facilitate the technology. It's really been a great discussion, a very unique discussion. It's not is very unique to what we've been focused on and right on strategy for our organization. So we have recorded this. We will put the recording on the GARI website. It will be under the convenings tab. For all the folks that were registered, we had 115 registered for this event. So all of them will get a summary of the discussion. I'll do the best I can at pulling out some of the key comments, but the full recording will also be included. Just garigroup.com is the website. And again, thank you to everyone. Very rich discussion. Very much appreciate all of your time and preparation. So thank you.
Thank you very much.